We are Tax Sherpa. This is Office Hours. If I sound hoarse, it's because I am. Been battling a cold. You know? Kids go off and do something and they come home and we all get sick. That's just, I'm sure all the parents are familiar with the process. So this is Office Hours Q&A, where we go over questions that have come in from clients and people that we've talked to, and all this kind of stuff. And I will spend the next 50-ish minutes on those, and we'll answer them all. So the great thing about the great thing about this weekly live stream that we do for me is that I have no idea what's coming. Serena does all the question collection and everything. And so she's just going to ask me stuff, and I don't know what's coming, and then I'll answer it. And sometimes the answers take 2 minutes. Sometimes they take 30 minutes. Just depends on what the question really is and how broad of a topic it really is. A lot of things sound simple and then end up not being simple. But who am I? And what are we talking about? So I'm Neal. I'm the founder, chief tax strategist here at Tax Sherpa. So I'll give you the quick version of my story. Basically, in 2000, I realized that the corporate world was not for me. That was 24 years ago now, almost 25. And I started my own, doing different entrepreneurial efforts. Some worked, some did not. And then in 2007, I started getting letters from the IRS saying I owed them over $1.3 million. So like most people, actually, and this might sound shocking, like most people, I stuck my head in the sand and ignored it and said, there's no way this is right. I'm just going to ignore it. And that is not the correct thing to do. So over the next couple of years, probably got worse and worse. And by 2009, they started garnishing my paycheck. And so I realized, oh, I got to actually fix my problem now. So I went ahead and did that. And in the process of fixing my own problems, I got into the Wall Street tax planning world. And since then, I have worked on over 50,000 tax returns of billions of dollars worth of client earnings and saving millions of dollars a year from the grubby hands of the government. And in 2019, and really starting in 2020, I went off on my own and founded Tax Sherpa with the mission to help the people like me. When I was in my former firm, we did taxes for all kinds of people making millions of dollars and people making $20,000. Some people owning their own business, some people being high-paid employees, some people being independent contractors, all this kinds of stuff. So Tax Sherpa, though, is really targeted towards the small business owner, the independent contractor, because what happens in the tax world is that there's two different levels of service. So there's the places that you can go to the shopping center, and there'll be one of those chains, and I won't name names, but I could. And you go in, you have your papers, say, here's my W-2, here's my mortgage statement, whatever it is, whatever you have. And they say, great. They enter in the computer, and they say, here's your tax return. And that'll be, whatever, $500, depending on what forms you fill out usually. And that's fine. If you have nothing complicated going on, then that can work. On the other end of the spectrum is tax prep and tax work done for high net worth individuals and big companies. And there, a tax return might cost you $150,000 because I saw an invoice for that from a corporate client that I was working on. And that's just the tax return. That's not even the advice that goes along with it. There's two very different markets in the tax world. And what I found was that the people like me, the independent contractors, small business owners, the solopreneurs, they're in between those two. They have a more complicated situation than just, oh, I have a day job and that's it. And they're not paying $150,000 for tax advice. And so there's nobody out there serving them. And that's where Tax Sherpa is really here for, because those are my people, fundamentally. And other people can chase into things, and that's okay. So that's what we do. And that's who we aim to serve, because they're just getting raked over the coals when it comes to taxes, because by default, they end up at that strip mall with the chain place, and they just fundamentally don't do a good job at that particular type of tax work. We'll file your taxes, sure, that's fine. But where we really specialize is on the planning side, on the advisory side. We're talking to clients now about what's going on in 2024 so that when 2025 rolls around, that everything will be in place and will already have saved tens of thousands of dollars on their income taxes. So that's the whole goal. In fact, before we get into questions, I'm going to talk a little bit about a new client that we talked to Monday or last Friday recently. Time gets a little fuzzy sometimes, and how sometimes planning is not the answer. But we'll get into that in a second here. So one of my favorite quotes, the quality of our questions determines the quality of our life. And that's Tony Robbins. And I think that's really true, because if you don't ask the right questions, you won't get the right answers. So my question is, what is the root problem with overpaying on your taxes? Because you don't have to minimize your taxes. You could go along and just pay more. Most people do, actually. But what's the actual problem with that? And to me, the problem is that you're actually wasting 74 days of your life every year. Because if you're overpaying by 20%, which we see all the time, and so I'm just picking that as just an average number. If you go out and you go to work and you go and do your thing, and then you come home and you turn that money over to the government in the form of taxes, then what did you really do that day? Did you work for yourself? Did you work for your business? Did you work for your family? Did you work for your community? None of that. You just worked for the government, and not particularly voluntarily either. To me, that's a day wasted. That's a day of your life that you can never get back, that you have turned over to the government when you didn't have to. Now, there are certain situations where, depending on what you have going on, there may be some that you do have to in order to go along in society. But we want to make those as few as possible. If you're overpaying on your taxes, those are days of your life that you can never get back, that you are wasting, at least as far as I'm concerned. We want to make sure that you are in control of your own tax destiny and are able to spend the time that you want for whatever you want, really. Because we talk to entrepreneurs a lot. So most entrepreneurs, if they get some time back for themselves, they're going to spend that reinvesting in their business. That's just how they're wired. But some people will take that time and apply it towards spending more time with their kids. Some will go on vacation. Some will go to Vegas and put it all in black. And all of those are still better than handing it over to the government, at least as far as I'm concerned. So that's what we aim to do. We aim to get you that time back so you can really take control of your own destiny. And also, I have the answer to all tax questions, just as an aside, because the answer to all tax questions is it depends.
It depends.
Yes, it depends, because it depends on what we call facts and circumstances. What is true for you is not necessarily true for somebody else. And my favorite example of this, I know I've been harping on the 1099Ks a lot lately, but my actual favorite example of this is cosmetic surgery. Cosmetic surgery is, and there's various types. Let's just say nose job, right? So you don't like the shape of your nose. You go to a plastic surgeon. You get it changed. Is that a medical expense? And the answer is it depends. So if it's because you just don't like the look of your nose, then no, it's not deductible. It's not a tax expense, because it is a choice that you made that is not required. However, if it's for, you get a nose, so Serena and I, before we started recording, we were actually talking about breathing and stuff. And so because I've been sick with a cold, so if I went and got nasal surgery to correct a deviated septum in order so I could breathe better, that is deductible, because that's fixing a function. A third case, if I was in a car accident and my nose got broken and I had a nose job to replace it or to make it back to a normal nose, let's say it was bad, I got my face really smashed in, even if it wasn't exactly like my original nose, that nose job would be a medical expense, because I'm restoring a function. So it's not just I'm getting those jobs just because I want to. It's because there's a medical purpose. So in all three circumstances, the medical event is actually the same. I'm getting a nose job, but it's the intent behind it that determines whether it's a tax deductible expense or not. People ask a lot about lawyer fees and are they deductible, because it sounds tax related, right? And the real answer is that lawyer fees are sometimes deductible, sometimes not. Depends on what the lawyer is doing. Like, what's the purpose of hiring this lawyer? If the lawyer is paid in the pursuit of income, then it is a deduction. It is a deductible expense. If it's paid for your divorce, then no, it isn't. If it's paid because you don't like your neighbor's fence, then no, that's not in the pursuit of income. Real life examples I have seen. So it comes down to intent. And this is true like across the board. And people don't appreciate this, because a lot of people who aren't in the tax world like we are think that the tax code is very black and white. It is anything but. It is all like fact and circumstances and what did you think you were doing and all this kind of stuff. So one great case of this, or type of thing that happens, is business loses money. And a lot of people have heard this rule, like, if business loses money too long, then it's not a business, and all this kind of stuff. And that gets into what we call the hobby loss rule. And basically, the IRS, in order to take business deductions against other income, if you have a business loss, then one, you have to have a business. And what does that mean? And that means you are pursuing income in some corporate form or company form. And pursuing income is not the same as making income. There is a place down the road from me where there's a grocery store that's where I go shopping a lot. And it's one of these shopping centers. And next to the grocery store, there was a place where they, it was, it was like those pour your own frozen yogurt places where they have all the machines and you pour your own in the cup and you put the toppings on, they weigh it, and you just pay by weight. It was like that, but it was for popcorn with different popcorn flavors. And they opened up, they had a big sign, they had shiny machines, and I never saw anybody go in the place. I never saw anybody in there while I was passing by because I wasn't a customer either. And then 3 months later, they were gone. So you got to assume that they lost a ton of money on that. The lease and machines and the outfitting and all that stuff. Is that a deductible loss? And probably yes, because they had the intent of making money, even though they lost their shirt. And if, on the other hand, you have a horse and you like to go riding and you just want to write off horse expenses, it's like, do you have a pursuit of income anywhere in here? If the answer is no, then it's a hobby and it's not deductible. Those are just expenses that you are incurring because you like riding horses. So that's just a couple examples of how it depends. You can have similar kind of actions. So before we get to questions, I did want to go over a bit of a case study that we had this past week, where we are all about planning ahead. But like everything else, it depends. So we had one new client, and she came to us, and she was behind a couple of years in filings because there was that whole global pandemic thing. And we were looking at her most recent filings, which was a couple of years old, and then we were bringing her up to date. That's all fine. Just as an aside, I found her an extra $5,000 from the last filing she did because there was a form that was filled out wrong with her company basis. But so we're filing the last couple of years, and then the question is, what are we doing for 2024? Because we're always planning ahead. We're always saying, what's next? Okay, we get up to date with 23, and then we want to be in a good position for 24. And normally what we would do is we would put together a planning package, and we would say, okay, we're going to do this, that, and the other. And in this case, because it depends, we actually looked at her numbers, and I did the rough drafts of the prior years. Excuse me. And turns out, 2024, her tax bill is going to be zero. So we actually don't need to do anything. And we don't need to do any extra planning because just of this particular client's facts and circumstances just removes the need for it. So even though that's what we do, we're not going to have to do that for this particular case just because of how the numbers worked out. And it depends, like at all levels. And that's what makes our jobs hard, actually, is that we have to look at everybody's individual circumstances. So are you married? Are you single? Do you have kids? Do you have business? Do you have investment property? Do you have stocks? Do you have all these other things? And do you have carry forward losses? Do you have whatever? So like for me personally, I have carry forward losses going on almost 20 years now. And so you could write off $3,000 a year on your capital losses if you lose a lot of money in stocks, which I did. So I'm in the home stretch of writing those off a little bit every year, but it just depends. So with that preamble, let's dive into the questions. What do we have going on? Oh, you're muted if you're talking.
Sorry, we have a question here. A client asks, I'm a non-resident alien in the US for tax purposes.
Yep.
What are the key things I need to know about filing my taxes?
So first thing is you file a different form. You file a 1040 NR. And last I checked, it's been a while since I filed a 1040 NR, but last I checked, you could not e-file them. You had to file them by mail. So that's thing number one. Thing number two is that it's a different form. In fact, let's do a little, because this is such a unique thing. Let's go here. You can see, can you see that? Actually, Serena, you can't see my screen. But yeah, so 1040 NRs get a little bit complicated in that they're pretty similar to the regular 1040s. But the most common thing that pops up is that there will be one person who is a U.S. Taxpayer and the rest of the family isn't. Depends on the situation, obviously. Some people, Like I had one client who he was actually in the jet business. They would lease jet engines. Little thing I didn't know before I ran into a bunch of these guys is that the engine on your plane, like if you go fly Delta, whatever, the engine on the plane is not part of the plane. It's actually a whole separate thing that there's all these companies out there and they'll arrange different engine leasing to different airlines, and some big airlines, some small airlines. But apparently they get swapped out fairly regularly for maintenance and age and whatever. But yeah, there's a guy who he was a non-resident alien. He had a place in South Florida, and his wife was just not involved at all. And so you get into weird situations with non-resident status where you're like single for US tax purposes, but you're actually married. And there's ways to include the spouse, but you may not want to because it just increases the complexity of things. So there's that. Also, the dates are slightly different. I believe the 1040 NR is June 30th. I'd actually have to check that, but I believe that's the due date as opposed to April 15th. But yeah, it's a different form. And fundamentally, what they're looking for is this term down here, which is on line 9, effectively connected income. That's a key phrase. So effectively connected income. So like for a US taxpayer, if you are a US citizen, you are required to report and pay on taxes on worldwide income. So we have what we call our adjusted gross income, which is a worldwide number. So I'm an American, I make money in America. If I also make money in Spain, then I have to report that income on my American return. That's actually different than most other countries. Most other countries only tax domestic earnings, but the US taxes worldwide earnings. I have to report on my Spanish earnings, and if I pay taxes in Spain already, I'll also report that. I'll get a credit here in the US against those taxes I already paid. Sometimes it's a full credit, sometimes it's not, depends on the numbers. So that's how it works for a US taxpayer. But for a non-resident, you're only paying taxes on US source things that are effectively connected. So money generated from US activity. There are other exceptions to that. We have a few clients who file as US disregarded entities. If you dive into the definition of effectively connected income, part of it involves having a physical presence. So there are a lot of people out there elsewhere in the world who want to do business with a US entity or through a US entity. But it's just there for filing purposes, basically. You get a US tax ID number, you can get a US bank account, but nobody has an office here. It's totally foreign owned and all this kind of stuff. And that becomes a disregarded entity for US purposes. And then it has to file a different form. It files an 1120 with the form 5472, and then that money flows through to their home, wherever that might be, and they'll pay taxes there rather than paying taxes in the US. If you're non-resident alien and you are filing 1040 NR, it's because there's some kind of physical component there that creates effectively connected income rather than disregarded income. So you got to nail down the differences there. But yeah, those are the main things to keep in mind. I know that I went over a bunch there, but
It's okay.
that's the starting point for non-residents.
Alrighty. Looks like we have a rental income question. So, what are the specific tax rules regarding rental income and expenses?
The specific rules?
What are the specific tax rules regarding rental income and expenses?
Okay, this one doesn't depend so much. But so yeah, if you have revenue, you're going to report that. And if you have expenses, you're going to report that. It does get more complicated from there, though. So if we're talking about, we're just talking about rental property, like a house or a condo or something. So that goes on what's called Schedule E, if it's owned individually. And if it's owned through a S Corp or a partnership, it goes on Form 8825. Or if it's owned by a C Corporation, then it's just part of the C Corporation, regular 1124. And what happens, though, is that you have your revenue. That's going to be the rent coming in. You're going to have your direct expenses, which is going to be if you have to advertise, if you pay somebody commission, property taxes, maintenance, all that kind of stuff. And then you're going to have the thing that trips people up sometimes is the mortgage payment. So the mortgage payment can consist of at least 2, but up to 4 things. And what that's going to be is there's going to be principal, interest, taxes, and insurance, PITI. At least actually that's not even true. It could be one, it could be just interest, it could be principal and interest, or it could be principal, interest, taxes, and insurance. That's usually the 3 breakdowns. And so the taxes and insurance are deductible, no question. The principal is not deductible. So if you are paying principal inside of a payment, It's not going to be that you pay 4 different payments. You make one payment, but they break it up into 4 different categories internally. The principal portion is not deductible because you're paying back a loan and you did not receive that loan originally as income. So when you bought the property, let's just make up numbers. Bought a property, $400,000. That's an average house in the U.S. today, and I got a mortgage of $350,000. Okay, so that $350,000 that the bank gave me for the purpose of buying this house was not income when I bought it because it was a loan. I have to pay it back. So the payback portion is not a deduction, just like the income or the money coming in was not income. The interest portion is deductible, potentially limited and potentially all this and that. So that trips a lot of people up because they say, oh, I paid $2,000 a month on my mortgage, so that's a $2,000 deduction. No, it's not, at least not usually. If you have an interest-only loan, then yeah, the entire thing's going to be interest because hence the name, interest only. So you got to be a little bit careful there. The other thing that people mess up all the time is actually depreciation. So when you buy a capital asset, it's going to have a depreciable life. So for residential real estate in the US, it's 27.5 years. Commercial is 39 years. If it's foreign real estate, if I have a property in Spain that I'm renting out, that's 40-year depreciation. And beyond that, houses and condos and apartment buildings and any kind of real estate is going to be composed of more than one thing because you have this big structure, but you also have cabinetry and appliances, and you have landscaping, and you have fences, and you have ceiling fans, and all these different things. And that gets into the concept of cost segregation, which is separating out all those different pieces so that you are depreciating each of them in their appropriate lifetimes. Appliances are going to be like 5 years, roofing is 15 years, driveways are 15 years, things like that. So whether that's advantageous or not is going to depend on the circumstances. We've got a whole flow chart internally that we use as far as does this matter for this taxpayer? Because if basically you have to have enough tax liability for it to matter, and you have to be able to take that deduction so that you're not limited because of passive activity loss limits, all these other things. But that's the general idea. So you have revenue, you have your direct expenses, you're going to have your mortgage interest, and then you're going to have your depreciation. You're going to subtract all of those from the rental revenue, and you're going to end up with a number at the end. And for rental property, that's like long-term rentals, because of the depreciation that you're taking a piece of that house or that condo or that apartment building a little bit every year, but the number is so big that you're taking a little piece of, that generally tips rental income into the negative category for tax purposes. So I don't want to say very, but the majority of the time, the rental income is not taxed at all because it's going to generate a net loss for tax purposes. Now, whether that loss is useful or not is going to depend on lots of stuff. It's going to depend on your overall income that year. It's going to depend on whether you're active or passive. And it's going to depend on how much it is, basically, and whether you employ a strategy like cost segregation, for example. I don't really want to get into the weeds of how all those work, but that's the general idea. Just think of rental properties as its own self-contained business. The income or the revenue is the rental income coming in. It's going to have expenses, and you record all those, and then you're going to have a net profit. And that net profit is going to flow through, in most cases, to the owner, whether it's through an S corporate partnership or individually, or a disregarded LLC or anything like that. The only exception to that is if you have a C corp renting out property, and then it just gets included with everything else going on in the C corp. And then if you take the money out, then you have dividends, and you'll have to deal with it at that point. But yeah, that's the basic approach. So goal is be cash flow positive but tax negative. That's the real goal. You're muted again.
Sorry about that. I have another question here. A freelancer wants to know, what are some important tax considerations that they should be mindful of since they're just now starting in the freelance kind of life?
I actually wrote 3 different ebooks about freelancing with beginner, intermediate, and advanced. But so thing number 1 to be aware of is, please make an LLC. That's step number 1, make an LLC. And then when somebody asks you for your tax information because, hey, you're a freelancer, we're going to pay you, you're going to get 1099, blah, blah, you give them the tax information of the LLC. So there's a form called W-9. In fact, I'll bring it up here. Form W-9. Copy from the IRS, March 2024, latest revision. Okay, so request for taxpayer identification number and certification. So this If you are ever paying somebody more than $600 over the course of a year, you're supposed to get one of these forms from the person you're paying so that you have their tax information on file so that you can issue them a 1099, notifying them and notifying the government that you paid this person. That's what the purpose of this form is. Line number one, which is where everybody screws up, is name of entity / individual. Okay? If you are operating as an LLC, which is 99% of the time for a freelancer, is going to be the way to go. We want name of entity. We do not care about your individual name. We are talking, so for tax purposes, a company or a corporation or an LLC are different than people. They're distinct entities. That's how you get the limited liabilities, because they're separate. If it's just you, there is no separation. You are a sole proprietor, and if you get sued, your entire life is at risk. Now, we're not lawyers. I'm not going to get into the liability thing, but just be aware that's how that works. If you're a freelancer and somebody asks you to fill one of these out, and maybe they give you the form, or maybe they have their own questionnaire that has the same information. So that just depends on if you're going through Upwork or something. They'll have their own form on their website, but it's the same stuff. So the name that we're looking for is the name of the entity, because that's a distinct entity that is separate from you for all legal and tax purposes. And then line 2, business name / disregarded entity name if different from above. This is if you have a DBA. So like Tax Sherpa is a DBA. We have a long corporate name that I've originally created because my branding brain was not engaged. And it's Online Tax Solutions Group LLC, DBA, Tax Sherpa. When I fill these out, I'll have Tax Sherpa as that line number 2. Most of the time, it's going to be blank. Box 3 is check the appropriate box for federal tax classification. And if you're an LLC, you would check the box LLC, and then you fill in C, S, or P. If you're a tax corp, S corp, or a partnership. One of the things about LLCs is that for federal purposes, they do not exist. They're called creatures of the state. And that means that you have to tell the IRS how you want to be treated for tax purposes. Sometimes you have to file a form, sometimes you don't. It just depends on the circumstances. Like with our clients, most of the time, we'll set them up as LLC S corps, meaning that they are LLCs, but for tax purposes, they are S corps. So they would check the box LLC and fill out the letter S. And then, but whatever the appropriate box is, you check that, and then address, city, state, zip, and all that kind of stuff. That's going to be for the company. Might be the same address as yours, might not be. Just depends on how you have it set up. And then the second thing that people screw up all the time is part 1 says taxpayer identification number. It says social security number or employer identification number. You should be using the employer identification number, because all of the stuff on the top fundamentally doesn't matter. Because when a form gets filed with the IRS, they match up based on the tax identification number, the TIN. That TIN could be your social, or it could be an EIN for a company. You want it to be the EIN for the company. That's bottom line. That's how they do all their matching. That's where everything has to reconcile. We see it so many times where people, they set up an LLC, and then they come to the end of the year and they give us a 1099 and it's got their personal social security number on it. It's like, why did you do this? The ones that get me the most are the ones that have, some will have one and some will have the other. It's like, why weren't you at least consistent? Just pick one. But yeah, you want to have the LLC EIN, the employer identification number, as the number you fill out that, because that's what everything gets matched up on a tax return. So there is if there's a discrepancy, meaning that the IRS got a copy of a 1099 from some organization, and it goes either way. If let's just say it has your social on it, and that amount is not reflected on your personal tax return somewhere, you're going to get a letter say, hey, you didn't include this, and we're going to, and the way the IRS letters work is like, you didn't include this, and we're going to assume the worst interpretation possible, so you owe us money, right? And this can work in 1099s if you're like 1099 NEC, which is non-employer compensation, which is independent contracting. It could work in stocks. Like we've had cases where people forgot about a stock trading account and they didn't give us the form, and then they get a letter later on. We have to go back and refile. But like we had one case a couple months ago where that happened with a stock account, and a guy had forgotten for 2 years running, had forgotten to give us a particular 1099 for the stock trading account. And the IRS sent him a letter, say, hey, you didn't include this, so you owe us like $8,000 or something. And then when we actually went through the numbers and we said, oh, it turns out you actually lost money on these stock sales, and we account for the basis correctly, then he actually ended up with a refund of $200. They just, when you get those letters, they will put the worst interpretation on whatever they can find. but it's automatically generated. There's no human thought that goes into these. Any letter that you get that starts with the letter CP is computer processed, meaning it's just sent out automatically. If you're a freelancer, so we're still on step one. If you're a freelancer, get an LLC, probably 99% of the time. That's going to be the way to go. Get a tax ID number. That's, you get that from the IRS. You just go online and there's a form that you fill out. And then when somebody asks for your tax information, you give them the tax information of the LLC and its EIN so that everything matches up at all levels. Okay, so that's step one. Step two, being a freelancer, is you got to open bank accounts related to your freelance company. So if you open an LLC, you go to your bank, say, hey, I need a business banking account for my LLC. Here's all my LLC information. And all money coming into the LLC, all freelance money that you make needs to go into that account. And all expenses that you have with your business have to go out of that account. You don't have to, but it's better, right? And from there, so that's your base level. From there, it gets more complicated because then you have to ask yourself, what kind of tax treatment am I going to elect? What kind of tax strategies do I want to implement? What kind of cash flow management strategies do I want to use? I highly recommend at least starting with the profit first method. It's basically you set up different accounts for different purposes. It's really solid as far as a first pass at least. And basically each one of those things is another version of it depends. Right? So depends on what you're doing, depends on how much money you're making. A lot of freelancers, if they're just starting out, they don't have a book of business, first year or 2 or 3 are often very slow. So it may not be worth setting up a whole lot of more advanced kind of tax strategies, but that's the basic idea. Create an entity for your freelancing, do business in that entity, go through the steps that it takes to set all those up correctly, and then go out and make money. Once you're making money, come back and talk to us, and we can put you in the right direction. Now, one of the things that is coming down the pike here in the next, I'm hoping in the next week, I'm not actually sure, is our 74 days course. And that will go over all these different basic building blocks on basically the first 100K of earnings. Once you get above 100K, it's okay, you got the basics, you have the basic structures in place, you have some basic tax strategy. Then we start needing to do more advanced custom stuff. And then it's definitely worth talking to one of our tax experts and getting a custom plan done. Bottom line, get the first setup correct, go out and make money, and then we'll talk about how to protect it all. Now, I will tell you, if you are new to freelancing, if you're new to the business world in general, the greatest temptation is to overspend. So this is where Profit First really shines, in that you create an account, a bank account, for spending purposes. So I don't know how much time I actually want to get into this, but it is worth talking about. So the fundamental difference between big business and small business is this. Small business has to support you. Big business doesn't. So if you are, I don't know, did we know what this person is doing, Serena, like business-wise?
No, they didn't say.
Okay. So let's pick a freelancer. Let's say you are a copywriter. You've been talking to a few copywriters lately. So let's say you're a copywriter. Company hires you, you write emails or blogs or ads or whatever, and in order for them to generate more business. That's great. So if there's a national copywriting company, then what they are interested in is generating profits based on the capital in the company. So if the company's worth $100 million, let's say, and they want to create a return on equity of 8% or 10% or whatever, then great. If assuming that they can do that and they can price themselves in the marketplace in order to achieve that, then everybody's happy. And investors who want to get a 10% return on their investment, that all works. If you, as a freelancer, try to survive on a 10% profit margin as return on capital in your freelance business, you will starve. This is the fundamental difference, because the company should be generating profit as a business and as a business asset itself, as a capital asset, and it's got to kick off enough profit in order for you to pay your rent or mortgage and buy food and send your kids to school and all the other stuff you have to do. And because of that, the small businesses tend to gravitate towards high margin businesses. So personal services, consulting, trades, all these kind of things that really don't scale very well. And basically, because they don't scale well, then it keeps out the big guys who don't need to generate profits in the same way that you do as a freelancer. So you got to keep that in mind. And because of that difference, then you have to be very mindful about what you're spending on and how much you're spending. The great thing about Profit First is just it gives you bumper rails. And so if you're in the 0 to 250K revenue range, which is most small businesses, most freelancers, then you're going to want to keep your spending to 30% or less of your revenue. So if you bring in 200K, you got to be spending 60K or less on running the business and attracting new business. And if you can do that, if you can control your spending, then the thing works. If you can't, then it doesn't. That's fundamentally the thing. I've seen thousands of small businesses that they make good money, but they spend it all. What are you doing? I've been as guilty as everybody. Don't make it sound like that, being judgy. But being able to operate your business profitably and profitably enough in order to continue to be in business next year and a decade from now is a critical skill that every freelancer, every small business owner, every independent contractor needs to have. But what I am working on, actually, a program to address this particular issue, actually, where I want to get together in small groups of 5 to 10 people, basically, where we'd get on Zoom calls and we'd go over how to structure their business and increase profitability. Because again, I see this every day. We see people who have small businesses who they're clearly serving a market need because they have revenue. If you have no revenue, that's a whole separate problem. But if you have revenue, but you don't have profit or not enough profit, then there's a business design problem that you have. And I want to fix those problems. And the initial goal I'm thinking is to add 5K a month to your bottom line. So that if you're making an extra 5K a month, generally that will get you over whatever hump that you're in for most people anyway. Obviously there's outliers, but most people, most small business owners, most freelancers, they make enough and they control their spending enough so that they're still there next year. Not always, but usually. But like nothing ever seems to go anywhere. And so they just keep scraping by year after year. And I really want to fix that problem. So I am putting together a group for that. And it is not defined yet. I haven't put up the waiting list page or anything, but that is coming. So just be aware of that because it's super important. So I don't know if I don't know if this resonates with anybody or not, but fundamentally, small business is what makes the world work.
Yes.
And it's not just America, the entire world. Because the only thing that is sustainable is a profitable business. And small business is where most business happens. Everybody talks about the Googles and the Apples and the whatevers. But that's actually not what most people interact with on a day-to-day basis. And what I mean by sustainable is that it's gotta pay enough so that you can live your lifestyle, and it's gotta pay enough so that there's profit in order to reinvest in the business to grow and become, better over time. Otherwise, eventually something happens and it'll just kill the business, and then you're done. So focusing on that piece is really critical. But I will keep you all updated as far as that group, if that strikes a chord with you and say, I have been in business and I'm making money, but I'm not keeping money. How do I fix this? That's what that group's going to be for. Yeah, I think that's, I literally have a whole course on this. It's coming, but that's my answer. That's limited to less than an hour.
That was awesome, though. Appreciate that. So we have another question about someone that haven't filed their taxes. So they want to know what's your advice for someone who hasn't filed their taxes in several years?
Okay. So my first advice is don't panic.
Don't panic.
I was there. I didn't file for, I don't know, 5 or 6 years back when I had my own problems. And so I get it. So the biggest thing that people, and I'm telling from personal experience, the biggest thing that happens is that if you go a little while without filing, like at first you're like, oh, I'll get to it. And then another year goes by, I'll fix it eventually. After 3 or 4 years, there's a lot of fear that starts to set in because you start to think, and I started to think, that it's okay, if I file now, isn't that going to trigger all these different things from all these years? And the answer is maybe. So the key thing, though, is the IRS and the states, whatever, what they really want is they want you to be in compliance, meaning that they want you in the system. So you have to look at the situation as a whole. Now, if it's more than 3 years ago, the IRS files what they call an SFR, a substitute for return. And what that is, they take all the 1099s and W-2s and whatever, and they create a pro forma tax return based on the information they have. And they'll say, okay, if this taxpayer filed with this information, what would happen? And it's always like the worst interpretations of things. And even if you would have been owed a refund, then you will never hear from the IRS.
Right.
If they do that and they decide that you would have owed them money, then you'll start getting letters. That's what happened to me, where they said I owed them $1.3 billion. The fundamental answer is we gotta fix it, and they can come in various forms. It could be that you didn't have taxable income if you were trying to. It's all different kinds of reasons, right? So if you were a student and you weren't working, or you were searching for a job, but you weren't on unemployment, but you didn't make any money that year, then there's no tax return required. It's only if you have taxable income. Or it could be that you did have taxable income and you do have to file, and you might, the longer you wait, the worse of a problem you might be building for yourself. And if you do have a problem, there are strategies to deal with them, depending on the situation. But fundamentally, you got to look at the situation, file what needs to be filed, and it's best to do it in order. So if it's been 5 years, you want to start with the oldest first, get that going, and file that. Because a lot of times there's carry forward effects. So you don't want to file this year and then file something 3 years ago, and then realize after you filed this year that there was something that carried forward over time and affected that thing you already filed. Then you have to amend. It's more bother than it's worth. So start with the oldest and then work your way forward. A lot of people lose stuff over time. So what you can do is you can go to the IRS and you can get transcripts of, there's different kinds of transcripts. There's a tax return transcript, which if you didn't file one, is going to be blank. But the major one is the wage and income transcript, which is going to be all your W-2s, 1099s, 1098s, all that kind of stuff. It's going to be whatever the IRS has on record for you for those years, they'll tell you. And since 4 years ago, something like that, they started truncating the information as far as the payer information. If you worked for, I don't know, Apple Computer, let's say, under the old system, it would say Apple Computer, and it would list out the EIN. And under the current system, it'll only list out like the first 4 letters. And then you'll have to say, oh yeah, I work for Apple Computer. That's what that was. And it'll also cut off the EINs, which is annoying. But there are ways to get the full thing delivered to you to a secure delivery system, but it's not simple. So you can go online and you can create an account at irs.gov if you don't already have one, and you can download transcripts there. And they go back, at this point, they go back a number of years. So it used to be much more limited. But if we're talking 2023 and relatively recent tax returns, all the information that the IRS has should be there. Now, what the IRS does not have is things that's just on you. So if you have a small business and you were making money, that's up to you to keep records. And you should be able to go back into bank accounts and things like that and construct profit and loss statements and things of that nature in order to file with. So the IRS is only going to have like third-party data. So if somebody issues you a W-2, they also issue a copy to the IRS and things like that. So you start with the oldest, gather up your documents just like you would for current tax return, and then you start filing. And if you have a tax liability from there, then you got to start dealing with it at that point. And there's different ways to deal with it. I know we're running out of time, so this will be the last question, but I will rail on the tax settlement people for a second. So you'll see all these ads. If you owe $10,000 or more in taxes, then call us and we'll get it eliminated or whatever. So there are 2 ways to reduce or eliminate taxes that you do owe. So if you don't owe them, then you fix the problem. If you do owe them, then there's what's called the offer income, and then there's the currently not collectible status. Those are the 2 ones that people try to do. Very rarely does this actually apply. So currently non-collectible status means that you go through a whole calculation of income, and you have assets, and you have cars, and you have houses, and bank accounts, and whatever else. And you come down to a final calculation. If that number is less than 0, that basically of the liquidatable value that you have access to, then you tell that to the IRS and say, hey, I would pay you, but I just don't have it, and here's my proof. And they will put you into non-collectible status, meaning that you still owe them money, but you can't pay. And then the trick is that if you can stay non-collectible for 10 years, then you apply for statute of limitations limits, and it just gets wiped out. So 10 years is the statute of limitations on federal tax. Now, California, by the way, has no statute of limitations, so that strategy doesn't work for California, but it will work for the feds. So that's so-called jackpot. Basically, you have to plead poverty, and you have to say I'm poor for 10 consecutive years in order to get out of it. The offer in compromise is a lesser version of that, where you go through the similar kind of calculations, and then you come up with a number and say, hey, I just don't have enough in order to pay this tax, so will you accept this offer as a compromise or offer in compromise based on my liquidatable net worth? And if the numbers line up, then yeah, they will take it. The problem with the whole offer and compromise thing is that if you had a big tax bill and you did owe it, you probably have stuff, and that blows up the whole thing. So most offers in compromise and currently non-collectible standard applications are rejected because of that. And for the people it does apply to, those are great tools, but it's not what the commercials promise, basically. The other way to deal with it is there are payment plans that you can get on. Usually they're like a 6-year payment plan, and spread out the pain, basically. Doesn't save you any interest or anything, but it does just spread it out and they won't hassle you. Or if you have, there have been many cases where the amount owed was, well, this is more if you already filed and created a tax problem, but a lot of times we can amend things were done wrong. So like the one that we did this past week, found somebody $5,000 because the previous tax person filled out the form wrong. The numbers were there, he just didn't do the work as far as establishing basis. There was all kinds of things wrong with that tax return, but we amended it and it says, okay, you're due a refund of $5,000. That's the best strategy, is to fix the problem. The second strategy is to fix the problem in a later year. If you can generate refunds in a later year, the IRS will keep the refunds and apply it to the past year, and it counts as a payment just like anything else. That's another way to go. But in the last resort, worst case scenario, there is a tax, there's nothing to fix it. You have too much to do offers in compromise and things like that. So you get on a payment plan and you just start chipping away fundamentally. And that's actually not usually what happens, because usually one of those other things kicks in. That's the worst case scenario. So as long as you're not being fraudulent about anything, then they just want you in the system. They're not going to put you in jail. They're not going to do anything like that. They're going to assess you some fines, some fees, as far as late filing and all that kind of stuff. But yeah, they just want a tax return. They want people paying or getting refunds as appropriate. The panic about are they going to send me to jail, you can take that off the table.
Right.
Unless you're doing something really shitty, and then probably don't want to talk to you.
Right.
All right. So that was all how it depends. And I know we only have 2 minutes left. So let's talk about next steps. I created a wait list for the 74 days course that is coming out. I was hoping it'd be done this week, but it's not. I've done all my part. I've done all the recordings of, there's a whole bunch of different modules and like 26 different lessons. And those are the things, a lot of stuff we talked about today, about setting up an LLC. Do you want to do S Corp or C Corp, partnership, basic tax strategies, how to set up your bank accounts, and all that kind of stuff. So it's perfect for that freelancing question. But if you go to taxsherpa.com/74-days, that will take you to the waiting list. You just put in your email, and then we'll notify you when it is ready, which should be soon. Should be. All right. So anything else you wanted to hit on, Sarita?
No, just want to sign off with saying smarter tax planning means peace of mind.
Awesome. All right. Excuse me. So we will do it all again next week at 6 p.m. Eastern, because I'm in the East Coast, and every Tuesday. If you want to submit questions to this, if you're in our Explorers or Navigators group, you just put it on the forum. Otherwise, you can just email questions, and we collect them, and we'll go over as many as we can get to on this live stream next week. All right. Catch you guys later.
Alrighty.